Hi friends, welcome to the NPTEL course Business Development from Start to Scale. We are in week 2 discussing the theme of business development strategies. In this lecture, the eighth in this series, we discuss vision, mission and strategy of a company. There can be a cascade for developing vision, mission and strategy. I explain this against the perspective of a global pharmaceutical company. I would urge the participants to discuss, debate, and focus on alternative statements of vision, mission, and strategy for the pharmaceutical industry, taking off from what I have presented here. Vision for a global pharmaceutical company can be developed as follows: contribute to a world free of infectious diseases with the therapeutics we develop, manufacture, and provide. Please note that this is a very broad statement, and particularly when we say therapeutics, it could mean many ingredients or many agents which can cure certain diseases. Therefore, therapeutics is a very broad word. Mission can be little more focused. The mission for the global pharmaceutical industry could be defined as become a one-stop shop for medicines and vaccines that cure and prevent any infectious disease. As you can see here, therapeutics has been kind of narrowed down to medicines and vaccines. There could be other therapeutics as well, but they are not included in the mission. The strategy could be focus on development, manufacturing, and marketing of the medicines and vaccines end to end from active pharmaceutical ingredients to finished dosage form. That is, more specificity has been provided to the mission. And in the case of another company, the strategy could be only medicines related and not vaccines related. So when you look at vision, mission, and strategy, you will find that mission could be a subset of the vision and in a more understandable, more foreseeable time span. Strategy would be a set of actions and set of plans which will define several ingredients that are required for making a mission possible. But once the overall strategy of the company is defined, we need to further cascade it down to the functional strategies. An R&D strategy for the global pharmaceutical industry could be focus on green chemistry for APIs and nanotechnology, pre-filled syringes for finished dosage forms. Note the important aspect here: green chemistry for APIs, that is active pharmaceutical ingredients, which traditionally involve a lot of chemical synthesis. Similarly, nanotechnology to ensure that the potency of the active pharmaceutical molecules is further enhanced. Similarly, for finished dosage forms, rather than have a separate vial and separate injection, the idea could be to have a combined prefilled syringe with the medicine inside the syringe. Similarly, the R&D strategy could be focus on biologics and vaccines as a preferred product group driven by genomics. Please note that when we say medicines, it could be small molecule medicines or large molecule medicines, that is biologics. So when it comes to the R&D strategy, the focus could therefore be much sharper in terms of the typical product group that is being developed. When you come to the manufacturing strategy, this strategy could look at complete integration or complete outsourcing. One option could be to stay technologically modern but also asset light by building a global network of in house and outsourcing facilities, both offshore and onshore. This is a broad enough definition but also helpful for developing a capital expenditure plan in an appropriate manner for the company. Then the marketing strategy would kick in. Focus on clinical integration of all stakeholders, genomic profiling of all customers to provide personalized medicine. To make sure that the medicines that are being offered are offered in a very unique manner compared to the competitors. So the marketing strategy has focused in a clinical way for better patient service. It also might talk about collaborating on an individual genomic ID initiative. So you can see that for a company which is in the pharmaceutical industry, vision is very broad, mission is much more specific, and strategy comprises of several actionable sets of activities to achieve the mission. Then various functional strategies provide greater content and greater color to the overall business strategy in terms of what each function could deliver to be able to satisfy the mission and accomplish the vision. That's how the vision and strategy along with the mission are crafted for a pharmaceutical company. Several functions are involved in developing the business strategy and, more importantly, in executing the business strategy. At the very corporate level, the corporate level goals are an amalgamation of business level goals. For a conglomerate, company goals are the discrete ones which are to be focused on, while for a company, the business goals are the discrete ones which will be focused on, and for a business, it would be the market goals that are going to be the discrete ones. Again, here you can see a cascade of how the goals are moving towards more specificity. When you look at the business strategy, it has got several contexts and contextual activities. For example, strategic business direction is one very important facet of business strategy. The scope of the strategy is another important facet of business strategy. The emphasis that needs to be put on new product development or on new market development are other important drivers of the business strategy. Similarly, when we talk about offshoring, when you talk about outsourcing, or when you talk about new vendor development, choice of strategic partners becomes extremely important. Then, equally important, where do you locate your facilities, be it the R&D facilities or the manufacturing facilities, the capital investments that are required, the pricing that could be adopted by the company in the marketplace, the product life cycle that is envisaged, and finally, whether we should divest or exit. So when you look at the key functions, that is the marketing function, the R&D function, the operations function, and the finance function, and look at these decision components of a strategy, you will find that each function has got different levels of weightage or influence in respect of those decision components of the strategy. As far as strategic business direction is concerned, marketing has got a high emphasis. R&D also has got a high emphasis because new markets have to be developed and new products have to be developed respectively. Operations relatively has a low emphasis because the overall business direction alone is being considered and not specific production strategy. And finance has got a medium term implication because ultimately the marketing and R&D investments have to be funded by finance. When you look at strategic business scope, marketing again has got a high emphasis. R&D also has got high emphasis because without product innovation, without broad spectrum product development, you cannot have wider business scope. Operations continues to have a low emphasis and finance will have medium emphasis. Same applies to new product development in respect of marketing and R&D because marketing drives new product development, R&D makes it possible. However, when it comes to operations, it starts assuming a medium level of emphasis because new products have to be transferred to the shop floor, and that's where the medium level emphasis of operations comes up, and finance has medium emphasis as usual. When you come to new market development, marketing obviously will have very high influence and very high weightage. R&D has low weightage because the products are already conceptualized and developed. Operations again has got low weightage, but finance continues to have medium weightage. When you come to choice of marketing partners or strategic partners, marketing has to have lower weightage compared to the previous decision control systems. You should have a medium emphasis in terms of marketing, low emphasis in terms of R&D, low emphasis in terms of operations, and medium emphasis on finance because strategic partners decide how much investment you need to make in manufacturing or marketing or R&D, whatever be the domain of the strategic partner. When it comes to choice of facility locations, marketing has very low impact. R&D has got low impact. Operations, however, has very high impact and influence, and finance continues to have medium impact. In respect of capital investments, marketing will have low influence. R&D will also have low influence. Operations has medium influence, but finance has got the dictating say in terms of what can be afforded or what needs to be marshaled in terms of new funding. In respect of pricing, marketing has got high influence. Similarly, finance has got high influence, but R&D and operations have low influence. In respect to the product life cycle, marketing and R&D have got high influence because R&D can extend the product life cycle, and marketing also can help extend the product life cycle with appropriate marketing inputs and also by providing appropriate inputs to the R&D organization. But operations and finance have low influence. Insofar as divestments and exits are concerned, marketing based on the marketability of the product, based on the product life cycle of the product, can have high influence, whereas R&D has low influence, operations has medium influence, and finance has high influence because divestments and exits determine whether there would be continuing cash bleed on the company of an unprofitable line, or the product line can be monetized to provide better opportunities for investment in future in other lines. Operations has got medium influence because the kind of facilities you have dictates the scope of divestment and the monetization that is possible with divestment or exit. So you can see from this that different functions have got different influences on the direction and the content of strategy. But you would have seen also that strategy is closely allied to the market orientation of a company. Companies which have got strong market and marketing orientation have certain corporate or business characteristics. These are as follows: 1. Market driven business development, manufacturing that is asset light, combination of internal and external product development, combination of organic and outsourced manufacture, strong marketing organization, robust investments in sales and after sales support, unwavering quality emphasis, strong market and customer interface for all functions, customer centric organizational culture, customer relationship management, measuring business effectiveness through marketing metrics, and finally, focus on customer experience. You can see the whiff of marketing in whatever the facet of business strategy you may consider in a market oriented firm. Market oriented strategic approach makes companies environmentally proactive because they're always thinking of the future developments in the marketplace, future mega trends, and the customer experiences. This approach also makes companies more responsive, at times more proactive, and definitely more agile, as the case may be. Let's look at Nike as an example of how marketing orientation helps a company develop its business successfully. Nike started operating from 1962. It was originally called the Blue Ribbon Stores. It focused on high quality running shoes designed for athletes by athletes. Nike's marketing position has been strategic and unwavering through the strongest possible association with successful athletes and popular sports events across the globe. So it was very completely focused on sports and athletes. Mission, when it started its business, was high tech shoes at affordable prices. In 1985, it signed up Michael Jordan and launched in 1988 the Just Do It campaign. In 1994, it authenticated the brand in Brazil. 1995 onwards, it started having widespread alliances with soccer and football. Again, in 2003, replicating the Brazilian journey, it authenticated the brand in Europe. In 2008, it sponsored China's Summer Olympics, and 2008 onwards, it started diversification of its association. It extended from soccer and football to tennis, basketball, golf, etc. And finally, diversified into sports accessories and sportswear. You can see how, from a core of football and soccer, it moved on to cover various sports categories and therefore started developing shoes which are more aligned to those sporting activities and remained focused all through this journey on sports and athletes. An aggressive marketing strategy with the twin pillars of sports association and athletic endorsements helped Nike become a strong show brand and diversifying into adjacencies over the next decades. Let's look at Google. It has achieved growth not by its marketing but through others' marketing. It was founded in 1998 as a search engine which offered its search product for free. Even today, it offers its search product for free. Google's zero pricing policy for its online real estate was a marketing coup that built for the company in infinitesimal value, that is, extended boundaryless value has been created for Google because of the marketing coup that it has stumbled upon in the beginning of its journey. So there are four facets of Google. One, create and distribute products for free. Continuous creation of online advertising space for advertisers seeking targeted advertising space. Second, AdWords as a platform for search ads, offering text-based boxes with advertisement based on relevant searches. A pay-for-click format has been devised, which provided for seemingly attractive payment rates, a huge payment estate for Google. AdSense advertising program, allowing any website to display targeted Google ads relevant to the content of the site. Website publishers earn money per click. Then, marketing asset management, data analytics that constantly improves web marketing through optimization of resources and budgets for companies. Finally, mobile and media toolkit, leveraging the power of Android and YouTube for a wide range of generic and customized products. Again, free services that mint money. So, strategic business focus together with constant product innovation, supported by prime online real estate for advertisers, is what Google is about. It is a USD 150 billion global digital giant deriving 95% of revenue from its advertising from the clients through its sites and products. It has become an enormous success as a company and as a brand, and that has been possible through the universal online estate that it has been able to create over the last few decades. We have another example from the white goods industry. Electrolux is a global leader in home and professional appliances. Electrolux business spans six divisions. It is a classic function of economic and demographic profiles. Strategy and marketing combined to power product market evolution. From the time the company was formed out of the merger of AB Lux and Svensa Electron AB in 2013. Major demand drivers for a white goods product are the following: per capita income, lifestyles, consumer spending, housing, urbanization. But for a firm operating in the industry, drivers of competitive advantage are global presence, design legacy, Scandinavian heritage, wide product range, people and culture. These have been demonstrated by Electrolux as a Scandinavia based company. So, how did it grow? It did several serial acquisitions. It acquired as well as developed strategic brands and achieved a level of global acceptability that helped globalization of its business. There are four pillars in Electrolux strategy: innovation, operational excellence, profitable growth, and dedicated employees. Electrolux proudly talks about its innovation triangle. It combines R&D, manufacturing, and marketing, and it has sought year after year to institutionalize the innovation triangle ever deeper into the DNA of the company. Business development at Electrolux is driven by institutionalized collaborative functional integration, and that has helped in global product market expansion. It also helped in the company's adjacencies being developed over a period of time. It has also resulted in higher financial horsepower for the company to acquire as well as to grow by itself. The other example is that of Emirates from the airline industry. I would say that it was like a whiff of fresh air in an airlines industry that was dominated by Western airline companies. It was established by the Dubai government in 1985 as the flagship carrier that it will enable global connectivity with and economic growth in UAE. It launched at scale from the inception, and therefore it caught flyers' fancy for its coverage as well as for its differentiated service. Emirates took to skies, serving 60 destinations in 42 countries straight away. Governmental support, of course, helped the company, but it also deployed modern, up to date airlines management systems and technological prowess to make sure that it sees itself as a differentiated airliner in the eyes of the customer. Emirates has a fleet of around 300 aircraft flying to 150 cities in 80 countries, and it has therefore become the fourth largest in passenger movement and the second largest in cargo movement by air. Technology has been a key driver, and experienced expat staff delivered the service for the customers. Emirates had 155 Boeing 777 aircraft and 119 Airbus A380 aircraft, and it has groundbreaking storage infrastructure in the Middle East. It also has exclusive state of the art Airbus and Boeing aircraft with superior interiors and facilities. Customer friendly check in, cabin, lounge, and baggage services, including home pickup and drop services, are offered by Emirates. It has got a strong balance sheet with good profit and loss. As a result, it has become a globally competitive company, and it has achieved superiority almost on par with established airliners like Singapore Airlines and Lufthansa. However, that has probably led to some smugness in the regional airline industry. As a result, competitors from other Gulf countries or other Middle East countries emerged. But Dubai and Emirates have been instrumental in creating the third largest global hub for air transportation after Singapore and Frankfurt. So, when you look at these kinds of developments, you clearly will understand that vision, mission, strategy, and the actual steps taken and the functional strategies have to be based on some kind of template which defines what the company is in terms of its strengths, weaknesses, opportunities, and threats. Therefore, to develop a good business development strategy, we require an incisive SWOT analysis. The evaluation of a company's strengths, weaknesses, opportunities, and threats is called SWOT analysis. It is a way of monitoring the external and internal marketing environment, or more broadly, the business and economic environment, and the ability of the company to grow in that environment. This SWOT analysis has two parts: one, information compilation, second, information processing. And these two are to be combined into data analytics. And the business mission itself is seen in terms of external environment, which is going to lead to opportunity and threat analysis, and the internal environment analysis, which will lead to strength and weakness analysis. And this process of moving on from the business mission through the SWOT leads to appropriate formulation of goals, then appropriate formulation of strategy, understanding the macro markets to operate on, and the actual execution in the micro markets that are covered by the macro markets. And finally, feedback and control based on the performance. BD is the art of finding, developing, and profiting from the opportunities in the environment aligned to the business strategy. Identification of sustainable macro marketing opportunities for strategic partnerships and strategic marketing ensures business development success. When you analyze a business, you got to understand, as I said, the opportunities and threats. So, what you need to have is to understand the industry in which you would like to operate. And if you operate in that industry with the kind of technology you have, would you have threats or opportunities? Now, let's look at an opportunity matrix and let us also look at a threat matrix. In respect of the opportunity matrix, the kind of technology which you are wanting to develop could have high success probability or high low success probability. The attractiveness of the technology could be high or low. So, depending upon this combination, high success probability and high attractiveness, or low success probability and high attractiveness, you could choose to deploy different types of technologies. For the grid which is marked 1, company could develop very powerful lighting system which could have high success probability as well as high attractiveness. If you develop as a company a device to measure the energy efficiency of any lighting system, it may not be all that is required in the marketplace. Therefore, the probability of success could be low, but it could be seen as an attractive proposition. If you develop a device to measure illumination level, it is going to be a commonplace development. Its attractiveness is low, but success probability could be high because it's going to be accepted easily in the marketplace. If you develop a software program to teach lighting fundamentals to the TV studio personnel, it is a very evolved method of influencing the key stakeholders in the television industry. But would it be successful? Because people would still rely on intuition and judgment rather than undertaking sensor based control of their activities. Therefore, the success probability could be low. The attractiveness in terms of the demand size, demand scale could also be low. Therefore, you can categorize each of these technologies or ideas that you have in terms of science and technology in terms of these four grids related to success probability and attractiveness of the idea. Now let's come to the threat matrix. Whenever you undertake a new activity, there could be a threat to the activity, and the threat could be probable to occur or improbable to occur. We could define that as high probability of occurrence or low probability of occurrence. The seriousness of the threat, that is, whether it could be quite threatening to the business or non threatening to the business, also could vary. So, the seriousness could be low or high. Depending on that, corresponding to the success grid, you also have this threat grid. If you develop superior lighting systems and competitors also develop superior lighting systems, there is a good probability of occurrence of a highly serious threat for you. On the other hand, if you have a major prolonged economic depression, it is not going to be every day, every year experience. But if it occurs, it will be of high seriousness, but the probability of occurrence can be predicted to be low or high. The higher cost you incur when you develop a new technology would have high probability of occurrence as a threat, but its seriousness could be low because it could be an industry-wide phenomenon. The legislation to reduce the number of TV studio licenses could be low in terms of the probability and also low in terms of the seriousness. Therefore, this opportunity and threat matrix is a methodology that can help you analyze the new ideas that you have in terms of your company's business development. For every opportunity and threat, a comprehensive analysis and discussion as above will help clarify the factors. We have seen earlier that strategy is a plan and methodology that may be deployed by a firm with resources to achieve objectives and goals, scope, goals, and resources. And this leads to sustainable competitive advantage. We have seen in respect of the four examples that I have talked about earlier, which is Electrolux, Emirates, Nike, and Google, that the strategy in each case had a clear scope, had a clear set of goals, and utilized the resources. And Emirates is a classic example of injecting resources early on in the business to attain a scale that will attract global attention. So, resources in this case include people, capital, technology, plant and equipment, as well as various other assets for the conversion process of idea to delivery. When you talk about strategy, you have to also remember that there are three ways in which you can look at strategy in terms of three levels. A company may choose to be in one industry but may operate more than one business with related strategy. So when you look at road transport industry, it comes into the limelight for a company based on the corporate strategy. If I am wanting to be in transport industry, which industry segment should I serve? So road transport industry, that is one. Somebody else may choose rail transport industry. Somebody would could choose maritime industry. that is the ocean shipping industry. Somebody could choose the airline industry. Out of these four broad sectors, a company could choose one sector such as road transport industry. But once you have chosen that corporate level strategy, you got to focus on the business you needed to be in or you would need to be in. You could be a vehicle manufacturer or you could be a transport service provider. That is someone like Ashok Leyland and Tata Motors manufacturing trucks and buses, or someone like bus travel services offering coaches for passenger transportation and trucking services like delivery. Once you do that, you got to understand in which product market combination you should serve. That is the core marketing strategy. Should I be in trucks? If so, I should be in the business of national level truck profiles or should be in the last mile truck delivery. Respectively, it translates to big trucks and the small trucks. In respect of buses, should I be in the publicly owned buses, which are the ones taken by state transport undertakings, or should I be in the buses? You can also define yourself whether you should be in the intercity coach service or should be in the intracity public transport service. And when you come to transport service as your business, you need to think of your being either B2B or B2C or both. For every business strategy, marketing strategies may comprise multiple product market options to drive growth. Therefore, in the same industry, which we call transportation industry, you have road transport industries as one of the four top segments, and within that, you got several options of conducting your business. So, this is the three level strategy framework which must be looked at. You can also define the same corporate business and marketing strategy in a different way. Scope may be reverse defined with a simple and ubiquitous product as the anchor that serves many segments. Let's look at smart meter as an example. A smart meter which measures the flow of something, and that flow could be electricity or it could be water or fluid, air, gas, anything. So, if you decide that you are going to be in the business of smart meters, you can choose a business strategy that is focused on energy industry or on the water industry. The flow meters obviously will vary. And depending upon whether you have chosen the energy industry or the water industry, the subsequent marketing actions also change. If you are in the energy industry, you got to focus on the power generators. You also have to focus on the power distributors. And when you talk about power generators, you got to think of thermal generators or renewable generators and distributors in terms of business or residential. And when it comes to the water industry, the split is a little more simpler straight away in terms of distributor or user. So the industry to operate in by and large determines the nature of technology that will serve as the base platform for a strategist. This theme will keep coming up throughout the business development course that we are running. There are four types of fundamental product market grouping. The product scope could be single product or multi product, and the market scope could be single market or multiple markets. This is slightly different from the variant which we have proposed earlier. That is, the existing products or the new products, existing markets or the new markets. This is a different way of looking at the product market segmentation. Let's look at the electric battery industry. A company may choose to be in the electric battery industry, but depending upon the mobility market it would like to serve and the type of batteries that are in the range of the company, four distinct product market groups can be identified. Suppose you have only one type of battery, that is a battery with very narrow energy range, and you are going to serve only a single market, for example, commercial vehicles. You could be for light commercial vehicles alone. However, if you have batteries of multiple capabilities, the range varies, the energy range varies. That means you are a multi battery product manufacturer, but you choose to be in only commercial vehicle business. Then you can support light commercial vehicles as well as medium and heavy commercial vehicles. Again, let's come back to a single battery product with narrow energy range, but you want to be operating in multiple markets, then you can serve with that kind of battery light commercial vehicles, cars and three wheelers, that is those which have got lower gross vehicle weight, and those which do not do national travel. On the other hand, you have multiple products in the battery range with multiple energy range levels, and you want to be in multiple markets, that is for all classes of automobiles. Then you would be the most diversified battery manufacturer, supplying and supporting all kinds of mobility solutions. Therefore, top down as well as bottom up segmentation of the industry and the business strategies along with related marketing strategies is important for developing business development approach. We have seen earlier that resources comprise not only the financial resources but number of other resources. These resources are critical to the execution of strategies and for accomplishment of goals. But granulation of resources is important so that you understand what resources are required by what activity and what resources you need to raise. When people resources are required, it will be facile to think of raising financial resources and vice versa. So there are six key types of resources. The first is obviously the people resources. In any organized activity, people come first, then only facilities come, and after that, only results can come. People, facilities, and results. So, it is important to focus on people as the most important resource that an organization must have. Adequate roles and numbers and required competencies. Headcount alone is not the judge of the people adequacy. People should be competent and capable, and the roles should be so structured that the operation in the chosen industry will be of competitive nature. Second most important, the finances. You should have proper equity debt balance, and the cost of capital for the company should be as low as possible. Equipment should be modern but affordable for a company, flexible and lean. Facilities must be frugal and competitive. They must be modular and scalable. There is no point in setting up straight away a 10 million capacity plant. You need to do it in steps of 1 million, even if you are in a reasonably, small product such as two wheelers. Management must be ethical and compliant, and it must be forward looking, agile, and flexible. And in terms of the intellectual property, product and process technology, as well as digital technologies and processes, are covered as the vital resources in today's IP driven era. So, the right scope, goals, and resources need to be blended together as a strategy that builds competitive advantage for a firm. I talked about this strategy for a company at a conglomerate level, at a company level, at a business level, at a marketing level. So let's put all of this in one frame of reference. So from a corporate mission, you get corporate goals and objectives, a corporate development strategy, and deployment of resources. These constitute the basic building blocks of corporate strategy, and the corporate mission is influenced by the environmental factors. Then these are cascaded to different strategic business units that the company has: SBU1, SBU2, and SBUN. And each of these things again will have the business unit's objectives, the competitive strategy that the business unit has to pursue, and the deployment of resources across product market combinations and functions. And each of the competitive strategies will have the functional strategy, marketing strategy, R&D strategy, HR strategy, and operations strategy. And from the corporate mission to the technical marketing plan for product market entry, you need to have a connectivity. And the connectivity covers the functional strategy, the business strategy, and the corporate strategy as demonstrated in this scheme. The hierarchy of strategies tends to be both top down as well as bottom up for firms having inclusive strategic planning. What do we try to accomplish through a company? We take an idea, develop it into a product or service, manufacturing it in a product environment, in a shop floor, and then providing it to the customer through the channels. So, this is called the value chain of the company or the business. So, it starts with the enterprise strategy, converts the idea into a product through the R&D, assembles the materials required for making the product through the inbound logistics, produces the product, of the required quality, delivers to the channels through the outbound logistics, and markets the product to the customer. This is the total company value chain or business line. And supporting this, we have information technology, environment, health and safety, finance, corporate affairs, strategy, legal, and secretarial, to quote a few. This value chain, the nature of it, the extent of it, the breadth of it, all vary from industry to industry in specifics, but the general departmental construct remains relevant. And each of these functions will have their own value chain. I'll take an example of the marketing value chain. Marketing has its own distinct value chain as below. It is driven by the business strategy and it connects with the customer. The business strategy is input and the customer is the recipient of the result from the customer focused marketing value chain. The value chain comprises market research, that is understanding the product or service needs of the customer, a product plan to fulfill that requirement, sales, distribution, service and parts, and aftermarket support. And supporting these things are the product concept and prototyping, market definition and testing, market segmentation and lab testing, demand forecasting and field testing, and fulfillment plan and pilot marketing. I'm not saying that these are related to each other. What I'm trying to say is that there are so many factors that are supporting a functional value chain. From prototyping through testing, lab testing, field testing, and pilot marketing, there is a prototyping and evaluation value chain for the marketing activity. Similarly, from a product concept through market definition, segmentation, demand forecasting, and final fulfillment, you got a product management value chain. And all of this, when supported with sales financing, leads to better customer acceptance and better demand for the product. Although technical in nature, the prototyping to piloting value chain also requires close marketing interface because the inputs given to this value chain as well as the outputs from the value chain act as valuable feedback mechanisms for perfecting the evaluation as well as for perfecting further product development. Having said that, we need to look at the demand forecasting, which is mentioned as one of the key aspects of the value chain. There are two types of forecasting techniques. One set is quantitative techniques, second is the qualitative techniques. In the quantitative techniques of demand forecasting, we have time series analysis, which is trending and correlation of data based on past data. That is, you analyze the data for the last 10 years and see how the demand for, let's say, ice creams varies over time. It may go up in summer, it may come down in winter. And this move of the graph, which may have a secular upward movement in line with urbanization, with income levels, with population growth, would show us a statistical trend. And you can correlate this data based on number of variables as well. So you can develop a regression function, you can develop a correlation function, you can conduct multivariate analysis to be able to forecast what the demand would be if there are changes in the independent variables. The second one could be smoothing analysis. That is, it is very difficult to predict demand if it moves on like this. But you may adopt a smoothing analysis so that the demand variations are smoothened out and you take care of the seasonality and cyclicality impacts. There could be barometric methods of quantitative analysis, demand simulation based on lead indicators. That is, you simulate the entire economic system and the industrial system and say that if the variables change like this, the demand profile would change like that. Then you have got hardcore econometric methods wherein you do multifactorial demand forecasting based on a number of economic and industrial factors. And when you come to the qualitative techniques, you got surveys, you got expert opinions. You can have response on new beverage taste. You can have the cost and price evolution of solar modules as two examples. The second one, that is the solar module cost and price evolution, is a field for experts. Whereas response on a new ice cream or a new soap or a new hair oil or a new beverage are best brought out through surveys of the users. So that provides basis for consumer research as a discipline. The choice of forecasting methodology is usually based on the product and the market, but needs cross verification from time to time. There are four ways to look at business development, I have told, in terms of the product market grouping. But a holistic business development must bring in other factors as well. For example, technology is a factor, globalization is a factor. You cannot undertake business development without environment empathy. That is the concept of producer's responsibility. I offer my products in plastic, but I also have responsibility to collect that plastic, recycle, reuse it, and that is your producer's responsibility. And that is also getting over to extended producers responsibility, covering even your vendors. Now that is the environment empathy factor of business development. Then you have social responsibility, that is keeping your workplace neat, your operating field people in good health and good shape, making sure that you have got gender equality, gender diversity, equity and inclusion in the employee base, and the standards to which you set yourself for in corporate governance. These are all market forces. The image of the corporation is determined by these five factors, while the brand can be built at a product level based on the product market choices and the advertising that is done for the product in the select markets. The corporate brand gets built not only by the product brand but also by these factors: the level of technology, the extent of globalization, the environmental empathy, the social responsibility, and the corporate governance. And these are required for you to achieve two things. You must be able to understand the new consumer requirements on one hand and develop new company capabilities on the other hand. When you have these two requirement sets and capability sets well in place, then you can have holistic business development. And that would include relationship and networking, integration between the partners, alignment within the partners, and mutual performance. These are the four fundamental pillars of holistic business development. And when you have this paradigm, which is inclusive of all these factors, then you will have strategic business development that is occurring. When you do business development, you are essentially offering products for customers. There could be consumer products for consumer markets, it could be consumer products for business users, or business type products for individuals. The combinations could be many, but each customer product configuration will have a level of profitability, because some customers are of low income capability and some customers of high income capability. Some products are of such technological nature that any premium is considered worthwhile, and some products are so genericized or so commoditized that they do not have any margins. So when you put a matrix of customers and products, customer group 1, 2, 3, and product group 1, 2, 3, 4, you can also see these customers as high profit customers, mixed bag customers, or losing customers. Similarly, the products can be seen as highly profitable products, unprofitable products, and highly unprofitable products. For a quick analysis, you may say that a company should be present in high profitable product and high profit customer area. You should not be there in a losing customer area. You may say that I would be there in only one type of category of profitable product and high profit customer. But these kinds of analysis are facile analysis. In the ultimate expression of demand, customers can be of different types even within one homogeneous marketplace. Let's think of a hospital. The hospital caters to different types of patients. Some are poor and indigent, some are rich and capable of paying for premium medicines or intensive care medicines. The hospital has a pharmacy. You cannot say that I will supply only the ICU medicines. I do not supply the low cost medicines which are unbranded, which are generic. You got to provide them. That is the bundling approach of strategic marketing. When you look at a macro market, the forward looking approach must be to bundle all kinds of products in such a manner that the premium products take care of the low margin products, and the low margin products ensures that the customers feel confident that any type of product can be taken from this company. So this bundling approach across the product profitability spectrum as well as the customer profitability spectrum is necessary. Companies must have more than arithmetic view of product profitability. They must have a strategic view or a business view of product profitability and customer profitability for them to have very effective strategic business development. With this, we come to the end of this lecture. Thank you for your attention. I hope to see you in the next lecture.